All right, everybody. Once again, welcome to today's Think Realty webinar with our esteemed panel hosted by Robert Knight and his team at Whitestone Developments, as well as our CEO with Think Realty, Mr. Eddie Wilson. I'm going to kick it over to Eddie. Good to see you, sir. Take it from here. Thank you.
Thank you. Appreciate it, Kurt, and everybody that's joining the webinar today. And maybe if you're watching this after the fact, appreciate you guys joining us. As you know, we try to do some of these in the middle of the day because I think it's just a good thing to do. Gives you a break, maybe to get away from work or to take a quick break to see some opportunity. But obviously, if you're watching this after the fact, we're definitely interested in hearing your thoughts on days to come on this specific topic. So let me just kind of introduce what's going on this webinar. As many of you know, I have been a huge fan of Florida real estate now for close to 10 years. And then I really got excited about South Florida real estate when I met a guy who you're going to meet if you don't already know him, named Robert Knight, who started selling me on this idea of the Cape Coral magic and what's going on in Cape Coral and all that there is to offer. And my first trip down there, I actually just went down as a quick survey trip, flew in, had Robert take me around, kind of show me what was going on and all the potential. And I fell in love and really saw the opportunity. And then I doubled down on that opportunity. I built my first Airbnb with Rob. And then I think right now, we've got a big multifamily under development down there. We have, I think I've got 8 single family houses under development down there. And because many of you follow my journey, whether it's through social media or through, vicariously through anything that my team puts out, I've gotten so many emails and text messages and DMs asking me, how can I be a part of what's going on in Cape Coral? And for many people, I just directed you right to Robert Knight. Poor Robert, gets inundated with me just sending him random people all the time that are interested in Cape Coral. And what has happened is Cape Coral, like most of Florida, has stayed hot. Even though, we've seen maybe a tiny bit of dip in some of the cost of land, the actual sales prices of these houses are still at number one, an all-time high, but without a reservation in my mind of it going back down or decreasing, mainly because there's just a ton of demand there and just not enough supply, which is the fundamental problem if you're a real estate investor that you like to solve, right? Play on the demand side, right? Or play on the supply side when there's a ton of demand. And so I got together with Robert a few months back, and we decided to go in partners on this opportunity. And so I am a partner. I want to disclose that I am a partner in this opportunity, but because I believe in it so much and because I've had so many of you, literally hundreds of people, especially after I went down and did the Titan Talk with Robert Knight, just hundreds of you reaching out to me, how do I get involved? And so I'm going to turn it over to these guys. They can kind of explain what's going on. They're the experts in South Florida real estate. And so Robert, Jake, Paul, appreciate you guys being on today. Super excited about what we're about to offer to the Think Realty universe and all of those that get to see this, because I know that they're going to get as excited about investing in South Florida real estate as I have been over the past 2 or 3 years.
Wonderful. Thanks, Eddie. Appreciate that. Hi, everyone. I'm Jake Marvin, Director of Investor Relations over here at Whitestone. We're going to share screen here, make sure everything's working all right. All right. And we can see presentation. Everyone see this all right? Eddie, Rob? All right. Wonderful, guys. Well, we are here today to talk to you about our Southwest Florida Single Family Home Development Fund. Essentially, we're also here to talk to you about how you can get a 30% average annual return on your investment. We're not here to waste your time, just here to give you a tremendous amount of value, educate you on the area and what we have going on down there, and present you with a premier opportunity for passive real estate returns. You currently, might be struggling with what a lot of people are struggling with having cash that you're sitting on that's losing its power due to inflation, or money in the market that's earned you only about 1% over the last 12 months. But we believe, that we have a much better option as far as where you can put your dollars in a place where they can truly start to be, working harder for you. So today, just so you know what's to come, our fund that we're going to be offering is, you can see down here on the bottom right, we have 256 homes and more as far as single family home development. It's going to be a 41-month fund with projected returns of about 30% average annual return and 29% internal rate of return. Quick hit on our disclosures here. Essentially for this roadmap, just a quick overview of what you'll learn today. We're going to show you why we love doing what we do, investing in build to rent, and also why we love Florida, why we love Cape Coral. Learn a little bit about us and our history and what Rob has built over the last years. And then really what we're here for, dive in deep into the fund to lay out why we believe that this is such a lucrative investment opportunity. So why build to rent? The build to rent sector has just been booming over the last 5 years and is primed for more growth. Why? Multiple reasons. One, Freddie Mac shows that there's 3.8 million housing shortage right now. So us constructing new high quality homes helps fill this gap and solve this problem. Also, build to rent single family has lower vacancy rates than multifamily and other investments. So nationwide, there's 97% occupancy for build to rent homes compared to 95% occupancy for multifamily. Better occupancy rates equals better returns. Also, as far as changing demographics and desires. So, baby boomers right now, they're retiring, they're downsizing. They don't want to take care of lawn maintenance. They want to be renting again. Millennials, on the other hand, they're starting families and prefer to be, if they're going to be renting, they'd rather be renting in a 4-bedroom home with a backyard for their families. Forbes shows more and more people every year moving out of the crowded cities. We got more people who are working from home post-COVID. They need an office space that their apartment just hasn't been able to provide for them. And they just like the flexible lifestyles of being a renter, no maintenance costs, no long-term living commitments, but still having the comfort and privacy offered by living in a house, versus an apartment. Also, changing financial situations, there's less homes on the market. There's higher cost of homes, higher interest rates. Unfortunately, it's making it really hard for first-time or young homeowners to be able to buy right now. It's cheaper to rent than it is to own. And, all of this together just makes renting a little bit more appealing. And last but not least, as far as, for you as the investor, build to rent offers multiple exit strategies for the investors. These single family homes, we can sell them at scale to institutions. We can sell them on the open market. We can refinance them and hold them for rentals. Or you can do a mixture of all of those, something you can only do, with scattered single family assets compared to one large single asset like apartment buildings. So moving on to why Florida? Well, first and foremost, as investors, you want places where the population is growing, where people are moving to. Florida is the single most moved to state in the country. In 2022, as you can see here, we had over 300,000 net migration. So that many more people moving to the state than leaving. That's been a constant trend. U-Haul has a stat, they check an index that shows where people are moving. One-sided U-Haul rentals. 10 of the top 25 cities in the country are in Florida. 4 of those are in Southwest Florida. All of this is going to lead to rising rents. There's more demand than there is supply right now. Florida's monthly home leasing costs are rising despite the nationwide trend of declining. And Cape Coral specifically, those renters lead the nation in paying 18% premium above the long-term leasing trend. And last but not least, there's a lot of tax, political, and business advantages of Florida. There's no state income tax. Wallet Hub states that Florida is the most business-friendly state in the nation. It's also one of the most landlord-friendly states in the nation, as well as, a lot of, political freedom too. And, just with businesses, starting businesses, of the 5.8 million new business applications, over 12% of all new business applications for the entire country were in Florida last year. And just, since the COVID pandemic, many established companies are relocating, they're moving. Like real estate investment group BlackRock, Goldman Sachs is relocating their headquarters there, along with thousands of smaller businesses as well, bringing their personnel, bringing their people. And this is all not even to mention, the better weather, year-round sunshine, and beautiful white sand beaches. So now why Cape Coral specifically as we continue to move down? I mean, it's ranked #1 in all these categories you can see here. Year-to-year rental increases, best areas for retirement, safest place in the entire United States to live. Cape Coral recently ranked 5th as far as mid-sized cities with the highest growth rates over the last decade. And although we are #1 for retirement, I do just want to say too, Cape Coral, the average age there is only 47. And the residents under the age of 25 actually outnumber the residents over the age of 65. So it is not just a retirement community compared to a lot of the other growing cities in the state. We have a young demographic, very family friendly, fun parks, water parks, things that families will stay and grow here for. And I want to give you a little quick visual representation. So hopefully we can get this part to show here, so you can see some of this beauty that Eddie was talking about.
Hi everyone, I'm Marina Gancharenko, a realtor in Southwest Florida, and today I'm going to give you a tour of Cape Coral, a water wonderland. 65 years ago, two brothers from Maryland bought this land and started to develop it as a master planned community. The unique vision they had appealed to so many people that the community quickly grew to a city of now 200,000 people. What makes it so unique is that it has over 400 miles of canals and waterways, and that is by far more than any other city in the world. That is hard to comprehend unless you see it from space. Here are the area stats for today. The city population is over 200,000. There is one beach, 21 different parks and attractions. There are 9 golf courses and over 254 restaurants. The city doesn't have any coastline, but instead has 7 miles of... Hi everyone, I'm Marina.
All right. Hopefully you got to enjoy the visually stimulating Cape Coral and all the beauty that it has to offer here. So right now, looking at Cape Coral, a huge part of it is that population growth. Just looking at the stats and the numbers tell a story. People have been and are continuing to move to this area in droves. You can see the last constant growth over the last 60 years. This is still a very young city, and just over about halfway to where the population can be of about 400,000 people. So for every 4 people in the area now, there should be 5 in 10 years, and Quicken Loans has it as the fastest growing city in America. Also speaking on to being I know we said we're only 60 years old, the city's also only about 60% developed. So that's not like this 60% is developed and this 40 isn't. It's this pre-plotted master plan city with scattered lots available all across the town that are just awaiting development. So I wanted to show you this area here. This is actually one of our favorite neighborhoods that we're building in. And just zooming in, this is a Google Earth picture. You can see all of the lots that are available. These homes, we're going to be able to build in homes in these already established areas that have lots of pride of ownership. Great areas to be building in, and you can just see the opportunity to be able to grow and scale this entire operation. So just quickly review why we love what we do and we love where we do it. Build to rent is a booming sector in the real estate industry. Florida has been and will be continuing to experience massive growth, and Cape Coral's population is slated to double in the next decades. So we don't just love build to rent and offering to do this anywhere. We're not doing this in San Francisco. We're doing it in Florida, in Cape Coral. We love exactly what we're doing and where we are doing it. Moving over quickly about us, Eddie gave us a nice introduction. Appreciate that. You have 4 of the 5 partners of the fund on the call here today. One of us must actually need to be working a little bit, but here we have Rob, our CEO, Nathaniel. He's our Chief Financial Officer. Paul is our Chief Investment Officer. I'm the Director of Investor Relations, and I have a hunch that you guys all know this other guy here. He's done some things, been successful, yada, yada. But we appreciate you, Eddie, allowing us to be here and present to the group. So I'm going to pass it over to Rob real quick, and what he is going to share a little bit about why he chose Cape Coral and what he's built over the last 7 or 8 years.
Awesome, Jake. Thanks for sharing that. Every time I watch one of these videos of Cape Coral, I'm so proud of what we're building here, what we're developing, the vision that they have. And in 2015, I was over in the Costa del Sol, and my wife and I and my family were deciding to move back to the United States. I had been in real estate doing various things, flipping properties, doing some commercial stuff, even acquiring some land for development overseas and some things like that. But we decided it was time to come back to the United States. I was actually sitting watching TV with one of at the time, my 7-year-old son, and he looked up on something on TV and said, "Dad, what's the 4th of July?" And I said, "Wow, we'd been so many years overseas without being connected with the United States. I had a 7-year-old who didn't understand what the 4th of July was." And that was just kind of one of the linchpins in just saying, yeah, it really is time to head back. So we decided to come back. But when you've been out of the country so long, the question is which part of the country would you like to go back? I grew up in Connecticut, which is extremely cold, lots of snow shoveling, and decided I really didn't want to go back to the north of the United States. And I really wanted to be somewhere on the water. I wanted to be in a place that we could really grow a real estate business. And so I just started looking around, and I started looking at statistics. And when I got to Cape Coral, it just jumped off the map, all the things that Jake just finished talking to you guys about. But I saw the vision of this master plan city that was half of it still unbuilt, and how gorgeous the area was. And then when I looked at the real estate values in relationship to other areas around the country, I was just convinced this area is the most undervalued, gorgeous place with so much vision, slated to really expand and grow. And so I came over to Cape Coral. I arrived in a rental car, grabbed an Airbnb, and then moved in with sight unseen, never visiting the city before. And I've been so amazed as we've been here, raising our family. My kids absolutely love it. Just the other day, I was watching my 15-year-old. One of his friends came over to visit, but when he came over to visit, instead of coming over like you normally would, driving over to somebody's house, they drove up through the canal system and pulled out. And my son goes off and meets him in the backyard because we're living on the water. And so you got your son heading off to go join his friends to go off boating throughout the canals. And I mean, we've seen dolphins in our backyard. I don't know how many of you have ever seen dolphins in your backyard, but I didn't have that growing up in Connecticut, and we have it here. So we love the area. We love the lifestyle here in Florida. We love the environment that's being created here, the conservative environment that we've got here economically. The market's on fire, and we just think we're here at the right time, the right place at the right time with the right vision, and super excited to invite all of you to come join us in this whole effort. And as you can see on here, Jake just put up our next slide with kind of just the group of companies that we have. And what we've tried to create here over the years is a turnkey system that would allow investors to invest in this beautiful place of Cape Coral, but to do it with a hands-off approach, much like you would do in the stock market. So what we've done is we've got Vantage Point goes off and sources off-market land for our investors. We're also realtors, so we can provide assistance in on the market through the MLS. But we provide a full turnkey system where we help you source the land. Whitestone builds the property for you. And then when we're done, B2R Living for rental management, we're able to put the properties in the portfolio for rental management for our investors. So it really provides true mailbox money for investors, where investors can get involved, and we can handle the process from A to Z. They do have to get a little bit involved in some of the things of financing and things like that. And so what we're looking at for this fund is to take it to the next level, where it's literally a 100% passive investment. You can take advantage of all the opportunity that's here without even having to go out and get your loan for new construction. So we're super excited to have you all here. And with that said, I'm going to let Jake take it away to the next step.
Wonderful. Thanks, Rob. So just like he was saying, why are we doing a fund? Getting to this point has been us kind of pivoting our strategy to meet the demands of the market. I mean, right now, institutions, hedge funds, family offices, they're looking to acquire completed homes to add to their build-to-rent portfolios, specifically in the Southeast. Typically, though, their bylaws, don't really allow them to take homes through that construction or through that development phase. So they're looking for completed properties. But our former strategy, was tailored more to building rental homes for the retail investor. So when these large institutions would come knocking and approach us of what homes of ours they could buy, we didn't have anything for them. This home was spoken for, that home was spoken for. And right now, with the kind of constriction of the market, a lot of retail investors are having that harder time, getting affordable loans to be able to build their homes. And us being able to offer a fund, as Rob said, is still a way that they can continue to invest with us even more passively, continue to invest in Cape Coral and in Florida real estate. So, doing this fund allows us to build and sell and scale at a larger scale, and really, be able to provide quality living for, thousands of people, even more people than we could before, and really help to solve a problem. So doing this really fits the needs of the market. Everybody wins. We can build more homes and give our investors a great return. We get to solve a housing problem for people in our city, and have our retail investors still be able to invest with us and really, be able to be a win-win situation for everybody. So on that note, getting into the fund, as we have here, this is currently a 41-month development fund targeting over 250 homes. It's just roughly about $95 million of total development that we will be doing, with an equity need of just about $11.5 million. This is a 506c offering. We are searching for investments from accredited investors only, with a minimum investment of $50,000. And as we mentioned before, we are projecting about a 29% IRR for this opportunity. And as everything we've talked about, we truly believe this is one of the most, lucrative real estate markets and opportunities that's available out there today. It's an amazing way for investors to be able to have not just superior gains, but be able to hedge against inflation and be able to invest in one of the hottest markets in the country. Just to show you a sampling, some of these are some of the homes that we will be developing as part of the fund. You can see we have a mixture here of different 3- and 4-bedroom models, a variety of layouts and living spaces. And as you can see, from these pictures, these are new construction, beautifully built, high quality homes that you can have as part of your portfolio in a Class A area and still be beating the market as far as what returns are out there. It's great when investors can feel confident that they're investing in assets and places that they actually would want to be able to live themselves. So not just, are we very intentional about what homes we build, but also where we are going to put these homes. So, just as Rob was saying, we've been down there. We know what we're looking for. We know what a good lot is, and we know what a good deal on that lot is. So we have a very specific criteria that's outlined here as far as what we're looking for on any of these lots that we are putting as part of the fund. They're in non-flood zones, so no flood insurance, no HOA required. We're also very intentional about building here in the north, in the northwest part of Cape Coral. This is the fastest growing area in the city. It also has many new developments coming, including right down here, there's a new marina coming to town, a 7 islands development, $650 million development. That's just going to be within a few miles of all of our builds, allowing these homes in this area to really take advantage of that future expected appreciation. Where we're building, they're majority owner-occupied homes, lots of pride of ownership. You'll see swimming pools, you'll see tile roofs, really great areas like the one I was showing you earlier. And last but not least, we do inspect each life for wildlife concerns. You know, we are in Florida. There are gopher tortoises, and there's other creatures like very cute burrowing owls like this. Now, they are cute little buggers, but we sure don't want them to be on the lots that we're building on. So we'll let them be cute creatures on other people's lots. So anyway, we'll inspect all these lots, make sure we're not running into any of those types of concerns either. And at this point, I want to pass it over to Paul. He can run you through some of our strategic advantages and the numbers of the fund.
Thank you, Jake. I appreciate that. And I want to just start off by saying thank you to everyone who's come out today. We really appreciate you investing some of your time with us. My role as a part of the team is I'm the resident numbers guy and strategic nerd. So I may go a little bit deeper into some of the competitive advantages, what makes our fund different than some of the other opportunities you may see out there. And I'm going to try to keep it extremely high level today. If at any point anyone wants to go into more detail for how these components work, I'd be more than happy to have that conversation separately. And we'll probably do some additional information for how the details of some of all this works. The main things that I really want to hit on here are the ability for us to maximize and amplify the return of our investors by internally compounding the equity within our investment. Secondly, the schedule for how we're rolling out our tranches is optimized to capitalize on the bonus depreciation and cost segregation methodologies that exist in the marketplace right now to allow us to exit some of our homes at C of O without incurring additional tax obligations. And thirdly, with this approach to the build to rent sector, we have multiple exit possibilities, whereas we can pivot depending upon however the market moves within the next 3 years or so. So a little more detail going into recycling equity specifically. Jake, if you would. This is a high level explanation, which probably will intuitively make sense to anyone who's already on this call, I expect, of how redeploying the same money into the same and similar execution strategy will amplify the annualized return. In this example, we have a simple $100,000 invested and consistently giving a 17 return on the properties over a 9-month development. That allows for us to take what would have been, if we'd redistributed the money immediately, would have been a 23% annualized return, and amplify that up to a 30% annualized return. And our program, as we can see on the next slide here, has been specifically scheduled over 9 different tranches to allow us to enter and start construction at a specific sequence where a portion of these tranches are being sold at completion, and a portion of them are rented and held for 1 year before selling to one of these large institutions that's looking for the long-term hold. That way, our assets placed into service within a given year will allow us to capitalize the bonus, to take advantage of the bonus depreciation and offset what would have otherwise been an ordinary income gain from homes sold at C of O. You can kind of note from this that there's a few moving parts as to why we're starting the specific number of homes in each specific tranche. But net, the core point is to redeploy equity in a sequence as accelerated as possible to ensure that that return is maximized going out to our shareholders. All of that is assuming, of course, our base case scenario and the market does what we think it's going to do. But what if the market doesn't do what we think it's going to do? Well, that's the important flexibility. That's really kind of the third thing I want to highlight here. While we are developing for a build to rent style, a build to rent strategy and execution, the plan of this fund is not to be holding the assets long term. The vast majority of the value creation is incurred through the construction process. And once we get that asset stabilized and up and running, we want to hand it off to somebody that is intending to hold the low risk asset long term and have a very low yield on that investment, comparably to what we're able to generate through this fund. Option 1 is that base case scenario. We're intending to sell essentially as quickly as possible in bulk at scale to one of these institutions. I'm having some computer issues. There we go. However, if for any reason the institutional underwrite of 250 homes were to shift over the next 2 to 3 years, we can just as easily pivot to sell on the open market, go through realtors, go to the MLS, and be able to receive standard market considerations. One quick note on the comparison between the two, we are underwriting for a decrease in price when sold to the institutions, but that's not what we're seeing in our conversations right now. Right now, we're actually finding that at scale, many of the institutions are willing to pay a price premium over what the open market is demanding. So that's why our option one is the base case scenario, but we're still being very conservative in our underwriting and assuming we're selling below market price. Then option three, if something unforeseen were to occur, we still have the option to hold until the market conditions are favorable. I don't anticipate anything could significantly decrease rents on a going forward basis. But if that were to happen, we still will have created a lot of value in the properties and be able to generate sufficient cash flow through our relationships with property managers that will be profitable in the meantime and allows us that flexibility to exit when the market conditions support a most favorable opportunity. At the end of the day, though, cutting out the complexity, the most important thing is, can you sell the home for more than it costs you to build it? Here's a simple breakdown of, on average, between the 4 different home models, what we have underwritten and what we are understanding that we can develop our homes for. And I think this is a fairly conservative number that we should pretty easily be able to put one of these properties in the ground for $350K. It's essentially $217 per square foot. Then looking at the current market, and our next slide is going to go into some detail on how we come to this $248.89 per square foot sales price. We think we can sell that same $350,000 home for $400,000 on the open market. And that's a conservative fair market value. Factoring in selling costs, debt service, and a 70% loan, then our total equity deployed is just under 120,000, and our gross return is almost 140. So we're anticipating about a 15.7% ROI per home on an individual basis. Now applying, well, let's first, before we look at how the compounding effect can amplify that return, let's go a little bit deeper into that 400,000. How do we get to the 248 comp, a price out there in the marketplace? Well, we've done quite a bit of analysis on our sales comps. These are all properties which have sold within the last few months here. With the ones in bold are homes that we have built using this exact floor plan within our buy box. And you can see that they're pretty consistently getting to the 242 number, even a few months back. And we're seeing as high as 270, maybe even 280 soon. Seeing some of the stuff that's trading right now is listed closer to the 280 mark. So we anticipate that this is going to continue with the historical trend of increasing in market value of the price of the home. Now that said, the 248 that we are underwriting to is the current sales price. And the previous slide, if you want to go back real quick, Jake, this number here of the 400,000 sales price, this does not include any appreciation that will occur during the development period. Normally, what's the case when people will underwrite, they will look to what is our sales price likely to be at the point when we're selling this home. We're not doing that here. We're being extra conservative and saying this is what it would be today if we had it on the market right now. So there's potential upside even between the numbers you're seeing here and what we're likely to incur when we get to market with these properties. So one other set of comments I'd like to make, one other point I want to explain before we get to the projection for our returns. We've split up this offering into 2 different ways to invest. The purpose of this is everyone has a different personal risk tolerance. With having a class A that is very stable and very secure, people who want to be all but guaranteed, essentially have very little concern about losing their money or even not hitting their return, can come in as a mezzanine debt holder that'll have a second position claim on the property and would be paid back first before anyone else. This money is also the last money to go in. We're taking no entitlement risk or pre-development risk with the Class A. This money is only invested during the construction process. And another advantage is cash flow is immediately generated because it's a debt instrument. That debt is serviced from as soon as the money is deployed. On the other hand, the Class B is deployed first to be acquiring the land on the front end. And this money has a little bit more risk exposure. In exchange, we're making sure that they are well compensated. We have what I believe is a rather generous promote waterfall, where we're ensuring you're getting to an 11 before any dollars are taken out by sponsorship. We do anticipate, even using this promote waterfall, that the projected return in our base case is going to be about a 29% IRR to our Class B investors. I would emphasize that the Class B does have more risk exposure, and this would be most appropriate as a balanced component of a portfolio. And that's why we're allowing investors to choose the allocation proportionally between the Class A and the Class B at your own discretion. I'll come back to that in just a second once we look at the returns for what a pure Class A and what a pure Class B might look like. That Class A per 100,000 deployed is, as soon as it's deployed, receiving that current pay of a 9.5%. And so through the 2 years or so that it would be outstanding, so remember this goes in last, then their return will net you about 15,000 gain or 15.5% ROI on that 100,000 invested. Class B, on the other hand, this money goes in first, and so it has a little bit longer horizon exposure. We're looking at from first dollar in to last dollar out about 41 months. Essentially doubling your money in that time period is our base case scenario. That's what our projection is showing. That amounts to about a 30% IRR or a 30.5 averaged annualized return when you divide out the total 104% ROI across the whole period. So then how do those shareholder classes benefit you? Well, you can choose dollar per dollar. How do you want it to be allocated? If you go a 50-50 blend, then we're still looking at a solid 22 IRR. You could go 70-30, be a little bit more conservative and go to the Class A. You can go 30-70 and go a little bit more to the Class B, take a little more risk and get a little more of that upside. And it's totally up to the investors, however they choose to allocate their dollars between the two shareholder classes. For now, I think that's enough detail. I know that throwing all these numbers on a page can sometimes be a little bit overwhelming, and we will for sure have more information available through the due diligence process if anybody would like to learn more. But this is a good high-level summary of what are some of those key strategic differences of our fund execution and what sort of returns we're underwriting for as our base case. And I will underscore that our base case is quite conservative here. I think there's a lot of upside above and beyond what is being presented. So back to you, Jake.
Wonderful. Thanks, Paul. Always appreciate your brain for the numbers. So, as Paul was showing here, for our Class B offering, right around 29% IRR. Just want to put that in your mind one more time, because just for comparison, right? We just went out on the open market and looked at some samplings of some other investments that are out there right now. These are also all, developmental opportunities also in the Southeast, very similar to us, also including even a similar build to rent development. And even looking across, the IRRs that are projected there, we have, 21, 22, 24 being, the highest one presented. But for that 24, you have a 1 year longer holding period and a much higher maximum investment. So we're doing all of that on a much, what we believe, better scale and offering a 5% premium on the IRR. I just do this to say, we fully believe in the market, we fully believe in the opportunity, and we fully believe in our ability to outperform and achieve better returns than, many other real estate investments out there in the marketplace. So as far as next steps, how we can come alongside each other to be hitting these goals, we'll be able to share, and I'll give you a second here where you can where you can find more of our information. You review this presentation, fill out docs, and complete your investment package. Then we'll be, verifying accreditation status, then wiring the funds over. Then capital is deployed into the projects and the returns begin. We expect this offering to be filled up rather quickly. We plan to be starting construction here in the next matter of a few months, starting to be purchasing land in the next matter of months. And I would love for you guys to be a part of that. So going into next steps, I have a couple links here that I can share in the chat, or Kurt might help me share in the chat so that you don't have to be whipping your phone out here real quick to get this taken, to get a picture here. But we'll drop these links in the chat where you can click right here on this link. It'll take you to a page where you can fill out some more information and then go right to our landing page. So you can see more of the fund doc, see this presentation, and that's where you can reserve your spot to invest. So we are accepting reservations right now, and we will be accepting official investments here shortly as well. So now's the time to take those steps, reserve your spot now before things get filled up. And with that, I believe, yep, Kurt just sent that link out to everyone, so you can take a look right there. And with that, we'll open it up for any sort of questions.
Yeah, Jake, you've got one question from an anonymous attendee. It says, how does Orlando compare to South Florida in terms of investments? How are the massive insurance issues impacting the investment returns? Could you guys be able to speak to either of those questions?
Yeah, as far as, with Orlando, and I will let Rob touch on Orlando and that area down there. But, when I'm talking with people and other realtors, a lot of times there's a little bit, obviously, less room for new construction in the Orlando area. But when we're talking to people, they say, hey, an Orlando real estate agent I was on just a few weeks ago, she said, hey, my people are looking for good investment properties or duplexes or any of this stuff. And as soon as it's on the market, it's already gone. Where the thing for us is, doing this in new construction in an area that has room for growth is we're not out there competing for opportunities. We're actually out creating opportunities. We have room to be able to do that. So that's one of the things that, we love about, as I was shown earlier, that Cape Coral only being 60% developed, and we can go out and create a lot of value through new construction compared to just buying already built assets. Rob, did you have anything you'd want to add on any of that?
Yeah, sure. I think one of the advantages I think we have here, again, because we have so much availability of land, we're able to have our pricing in terms of our product less than you're going to find in the Orlando, in the Miami and Tampa and some of these larger cities. We find there's we have a lot of people coming into our area, seeing the prices rise in some of the larger markets, looking for these tertiary markets like Cape Coral. And again, the vision that we have in our city as well is super attractive. So I just think that value for money, we stand out over all those areas, in my opinion. And in terms of the insurance, the question that was brought up, insurance prices, there are challenges in terms of insurance companies, especially after the hurricane, that we're sorting out. We're not having any problem getting insurance rates. Everything we model out, we always model out with current insurance rates, of course. But one of the other key things that we do, the biggest area where you find insurance rates have maybe increased, are in those flood zones. And what we're doing here on all of these offerings is we're intentionally purchasing land in our buy box for flood zone X, which is no flood insurance required at all because of the elevations already being very high. So that's an advantage there. It's about how you choose and where you choose to build your product.
If I could add to that real quick here also, it's a very astute question asked, because there are some macroeconomic considerations within the insurance space in South Florida, where there are a couple of insurers that have publicly stated they're pulling back from the markets. And there's a lot of consideration around whether insurance rates may be increasing in the future. I want you to know that within our underwriting, we have anticipated that there may be some increases there. And we're factoring that in both to our home selling prices and the cost of holding the assets when we're doing the rental period and retaining those assets on the books. Really, there's three factors that are driving the cost of insurance increase. Most insurance claims are either caused by A, flooding, B, hurricanes, or C, the potential risk is sea level rise in the future. And going in eyes open to understanding what the insurers care about allow us to preemptively adjust our development plan, anticipating even 3.5 feet of sea level rise, anticipating not just anticipating, but developing a hardened shell for the base of the asset to ensure hurricane damages are solely superficial, and there's not going to be any major claims that could risk the solvency of the insurer. And we have the ability across the entire execution to explain this to an insurer. We have the economy of scale and the buying power to have the conversation with them, whereas an individual homeowner might not be able to have that conversation directly and have that baked into the pricing that the insurer provides to our assets specifically.
Yep. And another thing to maybe point out important here is that all of our development is done with concrete block. All of our houses have hurricane straps that tie the trusses down, and it's literally tied down to the foundation of the house. And those hurricane straps are all the way around on all the columns or of the perimeter of the house. And again, tied into the trusses of the house. So really strong construction that's designed to resist and withstand any kind of hurricanes or things like that we might have.
And I would jump in and just say, you guys I had a brand new house that you just built for me that went through the hurricane. And I literally lost some shingles and a small tree in the backyard. I mean, that was, I fared 10 times better than the neighbors on either side of me. And the one neighbor was actually a brand new home that was built. And so just so you guys know, these homes are built, the elevations are right above the canals. I didn't have any flooding in the home, where the neighbor did. I had a few shingles again that came off, and we had them fixed within a day or two, and it wasn't a big deal. And then just that the actual quality of the construction is really well founded, right? Like the cinder blocks, the way that they're tied down, the elevation of the home, like it just, I had a lot of security. I was nervous like anybody else that went through that hurricane, but they sent me pictures within a day or two after, massive issues in that area. And my house was actually one that was rented out by a lot of the teams that were in there servicing the issues, because it was one of the ones that still, was completely intact, which was great.
Yeah, we had about 120, 130 homes in the ground during this recent hurricane, and no flood damage, right? Like Paul said, that's what you worry about. You lost some shingles, but all new constructed homes, we bring in feet of dirt, we build at higher elevation. So all the stuff that people saw on the news, was these older homes built in the 70s at lower elevation. But many of the new construction ones, we build at certain quality, certain code where, we just had the worst storm touch base in 500 years, or Lord willing, the next 500 years, and had 120 homes and not any water damage, flood damage that came into our homes.
I want to say, and feel free, guys, if you have any questions, now's definitely the time to ask them. I would highly encourage you guys to go on and set up a call if you have a desire to talk about this deeper and really get an understanding of like how your specific investment desires and needs ladder up to this. But one of the things that I'm super excited about as a part of this is the way that Rob and team have structured this for you, because while I'm building brand new homes down there, my rate of return on a brand new home is really not going to rival what this fund will do. And so I think a lot of times when you hear fund, especially a lot of you that do a lot of single family investing, and maybe you already own some of your own, you think, well, because it's a fund, I'm going to get less return than what I would if I was out doing these on my own. And by all means, like if some of you want to go direct and own the asset, contact Rob and team. They're happy to help you with that as well. But the reason that the fund is why I got so excited and wanted to partner on this fund was because it actually takes a lot of the risk of, number one, the single asset. Like, if you have one asset that you buy and you're all in on, and then it doesn't perform, right? Which is the benefit of a fund. You're spreading risk over multiple assets. Like, it gives you that benefit. But the way that they've structured this in a way that they're actually taking it and stacking these homes that are built, pre-buying lots, stacking the homes that are built, structuring it over time, performing them, and then exiting to, a hedge fund or a REIT, it actually provides you the best of both worlds. And why I was so excited about this fund is because I really believe that this offering is revolutionary to the fund, but it's also done in an area that's extremely hot, like South Florida. And so when Rob, called me on this idea, and showed me how they would structure it, and I have the confidence because these guys are building houses for me and their ability to actually get houses out of the ground and performing, why I jumped in and said, yeah, I want to partner on this and definitely want to bring this to all of my audience, because I just don't know that you're going to find a fund that can have this performance as well as providing the benefits of multiple assets to spread your risk across. If you don't have any questions, I'll kind of turn it back over to you guys. But
it looks like just had one come in. What percentage of the 256 homes will be constructed on canals? So Paul will be able to touch base on this a little bit too, but everything that we're doing is going to be very numbers based and very much on a per lot basis. So like I was mentioning earlier, when we know what a good deal is, it may be a really great deal to pay premium for a certain lot that has Western exposure, in a good area of town. So we're going to look at all of these on a lot by lot basis and then be able to underwrite each lot for what home we want to put on it. Is that worth it for the fund? So we don't have a predetermined number as far as what is going to be on the, how many are going to be on the freshwater canals, but it's going to be looking more on a lot by lot basis.
And to add to that, actually, Jake, if you don't mind flipping back to slide 15 with the different homes on it, we intend to underwrite each individual site with the different asset that we're going to be deploying into it. And so for a canal site specifically, we're going to need a higher return threshold in order to justify the additional risks of having to install seawalls and additional costs going in. And to that point, something like our Barcelona, which is really more of a designed long-term rental asset, may not give us quite as much yield as something like the Marbella. Something that is a little bit nicer, a little bit more spacious is going to be a better execution strategy where you have that canal access. So for our base case underwrite throughout the fund, we're actually assuming there's not a value add for the waterfront access. And if we decide to go after canal sites, then we essentially increase our costs and we also increase the return threshold that we need to see delivered from that asset. There's a few different home models that are not a core part of the base fund. I wanted to at least mention right here. We think 95% of what we're going to build through the fund will be one of these 4 models. But Rob also has 4 or 5 other home models that are designed more for like an Airbnb long-term execution. And when the site makes more sense to do something that's a little more upscale, we will pursue onesies and twosies, one-offs that allows for the investor to take advantage of the opportunity on that specific site.
And those will be more focused on the build and sell side,
yes,
to investors or to cash buyers. So just to clarify, of not changing and running anything as an Airbnb, this is a long-term rental fund. But those premium homes, when a premium lot comes up at a good discount, may provide even a greater return just on a build and sell basis.
Thank you for that question. That was a great question.
Just so you guys know, the bottom left one there is actually a home that I own. That's my Yucatan house. So
sure is.
Putting my house up there. I like it.
Well, it's beautiful. It's beautiful. We're proud of it. I'm glad you are too. All right. If you do have any last questions, feel free to throw them in the chat.
Well, if I can ask one, Jake, why don't you walk us through what the next steps might be, just at a high level, for once I click on these links, what am I going to see? And what do I need to do to start pursuing a possible investment?
Yes, absolutely. So Clicking on either of those links that are in the chat will lead you to kind of our landing page. I might not be able to lead you through while I'm logged in on the backside. But come into our landing page, fill out some quick information, and then you'll be taken to our investment portal. So in the investment portal, that's where you can, review more information. That's where we'll be getting you, links for further due diligence. And all of this, you can be scheduling a call to speak with myself about this as well. But in that portal, that's where you can click that reserve now button. And that's what is going to be holding your spot. So it's a first come, first serve basis. You can choose to invest either in the Class A or reserve in the Class B. Once we actually open it up for
both.
Or both, yeah. But when we actually open it up for investment, that's where you'll be able to kind of select both at the same time. But otherwise, you can go and you can reserve your spot right now. You can download this deck. It's on that investment portal as well. Feel free to, like I said, schedule a call. We'd love to chat, love to hear what you're doing and how we can best come alongside you. All right. I don't see any more questions there. Unless there's anything, Eddie or anyone else.
Yeah, I'll wrap it up, but I appreciate you guys jumping on. Thank you for obviously being a part of this. Thank you for letting me partner on this and bring it to the Think Realty world and all those that I know are looking for return right now, especially interested in South Florida real estate. Again, if you are somebody that's looking at this, like I really would encourage you to get on their calendar, dive deeper into this, underwrite it like you typically would, look at the numbers, and then have a conversation about what your investment structure looks like. I really do think that this is a radical offering. It's very different than most of the funds that you're going to come in contact with, and the security of being in South Florida. I just, I can't promote it enough, and appreciate Rob and team for opening so many opportunities down there. So thank you guys for being a part of the webinar today. Appreciate it. If you have any questions, reach out to these guys, and I hope you have a great day.